Morning. Today I would like to talk about trading basic call options, and I will use Tesla as an example. So let's get started. So basically in an option there are a few important things. The first important thing is the type of the option, that is a call. So we will just talk about call options in this video. Then there is a strike price, which is listed in this case as 125, and then there is a date at which the option might expire, which is January the 20th. So that's basically the main things that are in an option, and you can see that here the bid is at this $10.30 and ask is at 10.55. So if you wanted to buy an option, what we would do is you go to buy to option, you select a quantity of one, and then let's say I put in a price of 10.55, which is basically the ask price, and I can say review order, and it is telling me that I have to pay $1,055, and that's because one option is equal to 100 shares, so you have to multiply your option price by 100. So 10.55 times 100 would be 1,055, and then there is an estimated commission of 65 cents, and that's pretty much how you can buy a Tesla option. If you Once you buy that option before January the 20th, if you want to sell it, you can just say sell to close and then the same option, and you can give it whatever the price it is trading. Hopefully if the price is higher than 10.55, then you'll be able to make profit and you can sell it for a profit. So that's pretty much it. You can buy an option, buy to open and sell to close. That's pretty much all there is to options. So let me break down this a little bit further so you kind of understand how it is. So a call option is essentially a contract that gives the buyer of the option, in this case us, the right to purchase a security such as Tesla stock price at a specific price, and the specific price is called the strike price. So if you look at this value, you can break it down into what it says Tesla. It expires on January the 20th, and the strike price is 125, and C means calls. That's how the options are interpreted. So to reiterate, 1 is equal to 100 shares. This is the expiration date, and this is the price at which this option is trading. That's the price you can buy it. If you wanted to buy one call option, you'll have to pay the $1,035 plus the commission cost. So that's how you do it. So if you can sell this option for anything above 1035 before January the 20th, basically that will be your profit. So example, if you sold this option somehow for $12, then it will be 12 minus 1035 into 100, which would be $165 would be your profits. That's how you really profit with options for the most price. Most of the options are essentially bought and sold. In some rare cases, you can exercise an option, but we won't talk about exercising an option in this because that's not what most option traders do. To show it in a pictorial fashion, let's show this thing. So here you have a profit on this side and the loss on this side. And if the price of Tesla is $125 and above, then the option is said to be in the money. That means you can be profiting if the price of Tesla is greater than 125. So typically what happens is, if let's say the price of the option is less than 125, it's out of the money and it's considered worthless. So you'll pretty much lose all of the premium you paid, in our case $1,035. So that's what this is. This is showing. So if the price of the strike price is less than 125, you would be essentially incurring a loss, which is your maximum loss. And there is something called a break-even point. So let's say the price of Tesla on January the 20th is a little bit greater than 125 or at some values. If it reaches 135.55, that's called the break-even point in this example. Basically, you would have made no money or lost nothing and not really made any profit. So to make profit, you really would have to have the price of Tesla be greater than $135.50 at the day when the option is about to expire. And in this case, whatever the price is, you will be making profit on that. There's unlimited profit. That's what this shows. But for most option traders, all you need to worry about is if your option is trading for a value more than what you paid for, then you are essentially making a profit and you can sell it. at any time when the trading is open. And there are other things in the option as to how they are priced, like how did they come up with the price of $10.35 on a particular date. I will cover that in a different video where I will talk about the option geeks which are used for theoretical pricing. So I think for now we are good. And you, in terms of the trade and profitability calculators, many programs allow you this flexibility, and you can see it actually in this trade and profitability calculator. So if here in this example, you'll see anything above 135, our profit is zero, and more than zero if we keep going higher. Let's say if we go it up to this point, your profit would be on this line, which is about $1,167. Purple is a line which is showing you the profit at particular date. But this is not that important. The thing to remember is as long as you can sell the option for higher than whatever you paid for, you'll be making a profit. Thank you very much, and watch for the other. If you want to know more about the option geeks, watch for my second video. Thank you. Bye.